Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We have some economic data out as well. So the Conference Board consumer confidence falling a little bit, coming in at 100.4. Present situation coming in a little light, expectations a little light. But we want to get perspective on this, particularly as we head into the debate later on this week. Dana Peterson is chief economist at the Conference Board, and she joins us now. Can you tell me more about this data and what you kind of noticed from this survey?
Sure. Consumers are still having mixed feelings. For the most part, they're optimistic about their current employment situation. And certainly that's why the present situation index continues to be buoyant. But they're still very concerned about the future, especially with respect to business conditions and their incomes. And so when you net all that out, we're just seeing kind of treading water here with consumer confidence. It's not terribly different in terms of breaking out of the range we've seen over the last year and a half. But still in all, we're noticing that expectations are weakening, and that could start really weighing on the overall index.
Talk to us about that expectations. Again, it came in at 73, and that's down from a revised 74.9 last period. Where do you want to see that number? Where does that number need to be to suggest a healthy economy?
Sure. So anything below 80 usually signals that the consumer is thinking, well, maybe a recession is on the way. While that's not our expectation, we do think that consumer spending is going to slow over the course of the summer. Probably it already started in the earlier months of this year. It's going to continue. And also when we ask consumers, do you think a recession is going to happen? That ticked down in terms of the percentage saying yes, but still in all, they're very worried about what's ahead. Again, it's focused on business conditions ahead and their incomes, but they're not complaining much about employment. But even still, that employment gauge is below where we think it should be.
It's interesting you say that because I feel like Michelle Bowman versus Mary Daly over the last 24 hours told me something. And some are worried about inflation, like Michelle Bowman, and some are worried more about growth and employment, a.k.a. Mary Daly. In your survey, though, it seems like it's still just prices rather than jobs.
Exactly. So when it comes to prices, consumers are continuing to complain about the level. They're saying the level of food and gasoline prices are still too expensive, and prices overall are still higher than what they'd like. They're complaining less about the rate of increase in prices, which is inflation, and indeed the inflation expectations gauge continues to tick downward. But it's that concern about the fact that, well, eggs are $8, bread is $10, and that's really disconcerting consumers.
All right, Dana, thank you so much for stepping in and chatting with us. Dana Peterson is the chief economist at the Conference Board on the latest consumer confidence data. Came in a little bit weaker than the prior period. We'll keep an eye on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Carnival up over 6%. Here's what I don't understand. Carnival's doing really well. They're looking at good bookings, but then we got consumer confidence at the top of the 10 saying that people are worried, and they're worried about rising prices. I don't know how to square these two things.
I don't know. People are still spending on experiences, it appears like, coming out of the pandemic. I guess we kind of thought that would be a year or two, but they're talking about great bookings into next year.
I know. It's like, forget eggs, but we're going to go buy a cruise. Exactly. Brian Egger is Bloomberg Intelligence Senior Gaming and Lodging Analyst, and he joins us now. Brian, can you help me make sense of the strength in the likes of Carnival versus the overall feeling that consumers continue to say that they are stressed about?
Sure. I think what Carnival is seeing is going beyond pent-up demand from the pandemic to genuine, ongoing, sustainable disposable spending on leisure travel. So they're seeing it across the board. I mean, it really is broad-based. They're seeing it in Europe and North America. They're seeing it for both onboard spending and ticket fare gains, and they're seeing it both on new hardware and kind of legacy ships as well. So it is pretty broad-based.
So is it the typical cruising customer? Is it new people coming into the industry? What are they seeing here?
I think it's both. There's always a focus on new cruise customers and marketing the relative value of cruises compared to other forms of vacation. I think it's really both, and different brands attract different demographics and age groups. But to the extent that it's broad-based, and it seems to be happening not only in the first quarter but continuing to the second quarter, and as Alix mentioned, next year as well. I think we're seeing it across the board.
If we go into a real slump, or if inflation stays sticky, does that affect this sustainable leisure demand that Carnival and you were talking about?
It does. Certainly travel prices have increased, and we're seeing that just manifested in the fact that Carnival raised its net revenue yield growth outlook for 2024 from 9.5% to 10.25%. So they're partly benefiting from that price. But obviously, cost inflation does affect the disposition of consumers. But for now, at least, the demand on the consumer discretionary side certainly seems to be there.
How about on the cost side? I'm thinking fuel. I'm thinking labor. What's going on the cost side for a lot of these cruise companies?
Yeah, it's a factor. Certainly in terms of cost positioning, they've maintained, I guess I'd say, kind of a stable full-year unit cost growth outlook of about 4.5% or so, excluding the increases in fuel. There are some increases going on there, but they're also, to some degree, being offset where they can by operating efficiencies and where they can, refinancing of debt and interest. And they've also identified just operational cost savings throughout wherever possible. So it's a challenging cost environment generally for the economy, but they are, I think, seeing pockets of opportunity to manage and mitigate that cost growth.
Is there a distinction between Disney cruises and Norwegian cruise, like the ones that take you to Iceland and that Paul would go on versus the ones that I would have to go on with my kid? Are there a distinction, or is this like a broad stroke for the cruise guys?
I mean, there's certainly distinction across brands. To give you some sense of it, like domestically or in terms of U.S. brands, they saw yields up in the quarter 7%, European brands up 12%. So it's pretty broad-based with some differences and comparisons. I will say that the level of yield growth expectation, it's 10%-ish, as I mentioned, for Carnival. It's 9.5% for Royal, and it's a touch above 7% for Norwegian. And while there are differences across companies in terms of comparisons, I think you can say those are roughly in the same ballpark in terms of the inertia and momentum for bookings.
Is this an industry? Are they building new ships?
There are new ships on order. The level of supply growth slows down a little bit going into next year. It's kind of like a mid-single-digit long-term supply growth rate, which historically is actually a little bit more moderate than what we've seen over some past decades. So they are building new hardware, but they're also, this is kind of key for Carnival. They have been repositioning some ships and rebranding a lot of the former Costa and P&O Australia ships as Carnival brands. So in addition to some new shipbuilding, there's also some rebranding and brand positioning going on.
All right, Brian, we appreciate you. Thank you very much. Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst. Paul, have you booked your cruise? He's been talking about it.
There's potential there for the fall of 25.
Okay.
So we're still in the thinking stage.
Okay, so this will be like a good indication if this is kind of like spread outward.
And Charlie, he's all over the place.
He's the guy who does the weird things and then also cruises, so there is that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele, Paul Sweeney, we're live here from the Bloomberg Invest Conference in Lower Manhattan at the World Financial Center, bringing together leaders from asset management, banking, and the private markets. I'll tell you, the World Financial Center during the warm weather months is a magical part of Manhattan that I don't think a lot of people know about. Right on the Hudson River, lots of cool yachts, lots of great restaurants, open spaces for the kids to run around.
So nice.
Yeah, it's good stuff down here. So if you haven't been down here at this World Financial Center Battery Park area in warm weather, it's really, really a cool part of the city. You know what I've noticed over the years is the University of Illinois cranks out a lot of math geeks. I mean, like really smart mathy people. I didn't know that until I started seeing them all over the place. Daniel Morillo was one of them, co-founder and head of quantitative strategies at Freestone Group. Daniel, thanks so much for joining us live here at the Bloomberg Invest Conference. Talk to us about your firm. This is a new firm for you guys, recently set it up. Tell us about your approach to investing.
Yeah, I guess, well, first of all, actually, thank you for having me.
You bet.
I do own the Math Geek thing.
Yes.
I was going to say, are you a math geek, or did Paul just put that on you?
I am happy to own it.
PhD and I don't know what.
I'm happy to own it. Yeah, for Freestone Grove, co-founder Todd Barker and myself, we spent quite a long time at Citadel. And I guess the way you would want to think about our new firm, which we started about a year and a half ago, is we're looking to sort of evolve the integration of fundamental investing with quantitative process. Does the Math Geek thing, right? We believe that the way in which you manage to sustain alpha delivery from the fundamental process is to pair it with the disciplined understanding of what's happening in the markets via all those quantitative tools, right? And so we've made a very significant investment on our platform, all the mathy bits that go with it, and world-class fundamental team to sort of look to evolve that process, right?
So what is a quant strategy? And then how does that mesh with fundamentals? So the whole point of quants was because you didn't have to worry about the fundamentals.
Yeah, so I think you want to think in alpha space, if you're looking to deliver alpha, as opposed to just take risk, right? I think the objective of the quant side and the fundamental side is essentially the same, right? Which is you're looking for a differentiated view about the prospects of a firm. And I think the difference tends to be that in quantitative land, you're looking to get that differentiated view via taking advantage of very high breadth, right? So you look for some subtle bit of data that tells you very little bit about many firms, right? And so you essentially create what people would use a factor, where a little bit of information helps you make a small bet across, 1,000 stocks, right? Russell 1000 in the US or something, right? Whereas on the fundamental side, you're looking for the same thing, a differentiated view, but there you're much more focused on the idea that a human has the ability to come to understand a level of subtle detail about an individual firm at real depth that you couldn't get if you tried to do it sort of automatically across all the firms, right? So you focus on maybe 20, maybe 30 firms, and you'd spend your life literally thinking about these firms, right? And so it's a breadth versus depth thing, right? We think that in a sense you could put both of our worlds together, right? There are many firms out there who do each of these well. We think that putting them together actually is sort of the right way of actually thinking about it. There's no reason why they can't be together other than it's hard. You need two types of expertise. You need the management, you need the systems, all these things. So it is hard to put them together, but we believe you can, and that leads to sustainable alpha, essentially, quote, from both sides.
So I'm a former equity research analyst, so covering the media space. Let's say I come in one day and say, got to buy the Walt Disney Company here today, but the black box says sell it. What happens then?
I think you would like to think that in most cases that situation doesn't arise, right? And the reason why it shouldn't arise is because that last step that you talk about, right, which is I want to buy this stock, should occur on the back of a traceable, disciplined investment process, right? So by the time you come to me and say, I want to buy this stock, presumably we would have had a conversation, or in the tooling, you would have spent a whole bunch of time going to conferences, talking to firm management, building a financial model and putting estimates out there such that your conclusion, I want to buy this stock, sort of naturally flows from all the notes that you've done, all the work that you've done, let's say you're producing estimates for earnings, and earnings is next week, let's say. Your estimates are higher than the street, right? I think the street is missing something, right? And here's all the work that backs that up, therefore I want to buy it, right? So in that context, the quote black box is essentially all the tooling that helps you do that, right? So all the signals, the data that informs all the modeling that you do. It could be everything from satellite data that tells you how many cars were parked in front of whatever the shops are. Essentially, they work together. So by the time that decision happens, there's no sort of separation, essentially, or there shouldn't be at least, right? So it's not something that we actually worry very much about, because if you put them together properly, in a sense, the conclusion falls out from sort of having that traceable work, if you will.
So you were here, you just did a panel, and the panel name was The Right Mix of Humans and Machines. So it's going to be about using AI in this model.
Correct.
How have you found a good balance? How are you thinking about that balance?
Yeah, I guess that sounds kind of a trite thing to say, but the answer is basically it depends, right? It depends on the thing, right? we like to make a distinction between automation questions, right, where the technology AI now, but in the past it would have been machine learning, neural networks, data science of all kinds. It's evolved into being able to take on more of this kind of unstructured data stuff on the language side. But it's an evolution of the same, right? And we find that for automation tasks, the more you can push on things that are sort of not insight generation, right? Not where the idea comes from, but just automating the tasks. It's quite effective, and we generally have been sort of big believers that you want to invest in your ability to do that. On the judgment side, which is, will AI help me produce better insight, like actually a differentiated idea? We've been significantly more cautious on that end. And the reason for it is if you think about how AI is built out, you feed it all this documentation, and it produces essentially a probabilistic forecast of what is the next word in a sentence, or people use the word token, right? Next sentence, next individual word, etc. It is essentially built, in our parlance, you would call it's built to produce a consensus, right? You ask it a question, and the answer to that question comes from, here's all the documents about this topic, and the average answer, quote, the most likely answer is this.
So it's not differentiated.
Correct.
That's the problem.
And so in asset management, when you're interested in a differentiated view, AI is inherently not built for that, or at least not, quote, out of the box, right? So you need to think much more carefully about how do I use that as a starting point for thinking about summarization questions, directing attention, detecting themes, measuring sentiment, all very useful things that might lead you to have a better insight, but it's not insight generation itself, right? And so then the topic really sort of matters, right? Is it writing code for the engineers? Maybe not so much, but is it the ability to summarize a huge amount of data? You were an equity analyst, right? Part of the job is you show up in the morning and there's like a million things to read, right? There's all the sell-side analysts, all the transcripts from conferences, all the news about the company, right? Just the act of reading is a big deal, right? So you can imagine how AI might be helpful in directing attention and highlighting new emerging themes, etc. You probably still want to be reading at least some of the key pieces of it because you would worry about where the insight comes from as opposed to where the summarization comes from. Does that sort of make sense?
Yes, actually.
Yeah. Real quickly, 30 seconds, how have some of the early returns been for your firm?
We've been doing sort of about what we planned. You call me a math nerd.
Yeah.
We did quite a lot of simulation about how the thing should work when we started going, right? What sort of returns with what assumptions. And we're basically tracking to what we would have expected at this point.
What's your benchmark?
No benchmark, right? We market neutral. We are perfectly hedged to, in our case, S&P 500. We also take no factor risk. And so essentially the benchmark is our ability to deliver uncorrelated returns to the other benchmarks is essentially how you think about it.
Does AI, real quick before we go, does AI stress you out? In what way might AI stress you out?
It doesn't stress me out.
It doesn't stress you out, okay.
No, it's kind of exciting, right? Okay. New things are always exciting.
Huh. See? That's not
because he's a PhD in math.
Right.
That's why they like that
so
stuff.
So math geeks like new, cool, nerdy things.
Yes.
Got it.
We definitely like the cool stuff. Yes. Thank you.
All right, Daniel Morillo, thank you so much. It was a pleasure to have you stopping by. Thank you very much. Co-founder and head of quantitative strategies at Freestone Grove Partners. He coined himself a math geek, so we'll just go with that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix here alongside Paul Sweeney. We are live from the Bloomberg Invest Conference in Lower Manhattan, bringing together leaders from asset management, banking, and private markets to ask questions about what's going on. How do you think about AI? How do you think about cash? And luckily, we have one with us right now, Ed Cass. He's Chief Investment Officer at CPP Investments. That's Canada Pension Plan Investment Board. Now, Ed, thanks for joining us.
Thanks, Alix.
I'm asking for a friend. Say you have some money in a high-yield savings account or in a money market fund, and you're sitting pretty right now. You're getting paid between 4 and 5.5%, and it's fine.
And you're young.
And Paul, so nice. And I may be somewhere in the middle of young. What do I do? What does one do?
What does one do? If you're young, then the way we think about it is you have a longer investment horizon. You have a certain capacity to take risk. When I think about investing, the first thing I think about is what kind of risk should you be targeting in your account, in your overall portfolio, and then trying to design a portfolio at that targeted level of risk that kind of maximizes returns. So if you're young, you probably have a pretty high risk tolerance.
Are we defining young? Can we define it?
Yeah, I've defined it.
Because I have no risk tolerance whatsoever. But does cash play a valid part in how you guys think about stuff right now in allocation?
Not for us, because we think we're really, really young. So if you think about an institutional investor and you try and transpose that into years, we think like we're a teenager with a whole bunch of savings, which kind of an oxymoron, but that's where we start. And the way we think about risk, or the way we communicate risk, is we put it in what we call equity debt risk equivalence, because that's kind of an easy way to explain or communicate risk tolerance to someone. So we target a portfolio that has a risk equivalence of 85% equities, 15% debt. So if I'm explaining that to my mother, she knows, hey, typical person is probably 50-50, you're a little bit aggressive, you're 65-35, we're all the way up at 85-15. And then we try and maximize our return at that level. And that's where you start thinking about, hey, what are the relative returns of stocks and bonds and cash right now? And how do you construct a portfolio that, as I said, at that targeted level of risk maximizes returns?
How about alternatives? How do they fit into your portfolio? Because when I think about some of these endowments, how aggressive they've become in alternatives, I guess the Yale model, for lack of a better term. How do you guys think about alternatives?
Well, there's a pretty big difference, I think, between the objective function that some people have and the one that we have. So I said we're risk targeters. So we kind of set that level of risk, and then we try and maximize returns. A lot of people are return targeters, and they're trying to maximize returns. So they don't mind increasing the risk profile of their portfolio to achieve those higher returns. For us, if we're targeting risk, then we have to say, do alternatives to private assets provide some measure of diversification in a portfolio context that is different than what we get in the public markets? And we don't think so. So we think at a very high level, if you invest in private equity, that's like levered public equity. It's not really different in terms of the drivers of returns. So you don't get any diversification benefit per se. Bit of a generalization, but it's true. So then you're really into returns. And from a return perspective is, can you pick up alpha by investing in private assets? And I think there's a lot of reasons why you can't, especially if you have some comparative advantages, whether you can do some direct investing yourself to lower the fee burden, or whether you can negotiate particularly good terms for going in a fund, you can generate additional alpha. And that more than anything really drives the demand for private assets for us.
That's interesting. What do you make of things like crypto and like Bitcoin, where you can get that in the public market? But you can invest in, say, a micro strategy that's basically going to just invest in crypto. I mean, in the public market. Like, is that anything interesting there?
I think let me start with two things. So crypto as an asset class, I don't understand what the drivers are in particular. So I don't understand what, in our parlance, we say, what is it loaded on? Is it loaded on growth? Is it loaded on inflation? Is it loaded on something else? Or is it just an instrument that kind of goes up and down with market sentiment? And I think the jury's still out there. I certainly don't have enough conviction as to the drivers of Bitcoin or some kind of crypto asset to build them into a portfolio design. I do think there's spaces within crypto where people can kind of get in the nooks and crannies and generate additional alpha. So can you give money or capital to someone that can take advantage of those and generate alpha, and you can use that in some kind of portfolio construct maybe. But so far we haven't gone into any of those assets or any of those funds that kind of try to take advantage of that feature.
So where do you guys see opportunities now?
Lots of different opportunities in a lot of different spaces. I'd say the one that a lot of people are most excited about right now is private credit markets. Certainly private credit is something that we've been involved with for a very long period of time. I think we're close to 15 or 20 years in terms of internal capabilities.
We just started hearing about it in the news, I guess, in the last 3 or 4 years, it seems like.
It's become a huge thing in the last 3 or 4 years because a lot of the traditional GPs, general partners that were involved in private equity have kind of branched out into private debt as an alternative asset class or an alternative way to gather AUM. So that's really the big impetus. And of course, you've got some big macro drivers behind it in terms of regulation and bank balance sheets and trying to diffuse risk through putting money into private hands as opposed to bank hands that have been supportive of the asset class. But we identified it as something that could be interesting, as I said, a long time ago, and started kind of building out the internal capabilities to invest in it. So we're kind of lucky. I think we're in at the start, so we've got developed capabilities, and the rest of the market seems to be catching on right now.
So if we just take a step back and look at maybe some of the risks, how much of what how much of the risk that you want to take is dependent or not on like geopolitics, on fiscal policy, on things you have zero control over that definitely can affect how asset prices move?
Super interesting question, obviously, these days. Again, if we're an 18-year-old investing money over a 75-year time horizon and we have a reasonable amount of money, which is, I think, the situation we're in right now. If we project out the size of our fund another 10 years, we're up to $1 trillion. I don't think at that level you can be as flexible or as reactive to say what's going into the market. I'm going to change my asset mix and I'm going to respond to it dynamically and take advantage of all these shifts. That's not the way we think about it. We think more, how can we build something that, irrespective of what happens in the market, irrespective of what geopolitical risks emerge, that we can survive that outcome and continue to invest over a 75-year time horizon. So for us, a lot of people use the analogy of like a super tanker and how tough it is to turn a super tanker. I think the analogy that we're kind of landing on more internally these days is we're like an icebreaker. You got to be able to drive through a whole bunch of geopolitical risks. You have to be able to drive through a whole bunch of regulatory risks and be able to emerge out the outside, out the other side, and still be in a position to invest money and take advantage of those longer-term opportunities.
Hey, Ed, we really appreciate it.
Yeah,
that was
great.
really interesting. Ed Cass, Chief Investment Officer, CPP Investments. It's just always those black swans, right?
Yep.
Like, what happens if there's another war somewhere? Like, no one expected what would happen with Ukraine and Russia.
Right.
Like, no one expected what's happening in Gaza. So it's like, how do you deal with those situations, particularly as we head towards a presidential election? I definitely do not envy a Chief Investment Officer.
No, not
based
exactly.
on all of that.
Or an asset allocator, one of those folks.
Yeah.
So they get you, but you have to deal with these things, and you got to try to price in some level of risk, and that's what those smart people do.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Sweeney, Alix Deal. We are here at Bloomberg Invest, broadcasting to you live in Lower Manhattan. We're bringing together leaders from asset management, banking, and private markets here over the next 2 days. Joining us on set is Kristin Roth DeClark. She is Global Head of Technology Investment Banking over at Barclays. Kristin, what is Global Head of Technology Investment Banking?
Yeah, so within Barclays, I run the team that helps advise companies, board members in terms of on the technology side with things like fundraising in the capital markets, IPOs, debt capital markets, leveraged finance, or on M&A advisory.
How does private credit, we talk a lot about private credit, private capital. I know in your business and technology, Sand Hill Road is where all the equity money. Talk to us about private equity and private credit in technology these days.
Yeah, so on the private equity side, if you look at the growth stage investing that's happening, kind of late stage growth is where a lot of funds are focused, kind of the pre-IPO rounds. The earlier stage stuff is more, it's some of the AI companies that are coming out. There's like the venture investing that's happening there, but it's a little bit more of a portfolio approach because it's too early to kind of tell who the winners are going to be.
Right.
As you get to the growth stage investing, there's more focus on where the likely exits could happen. I think there's been a meaningful shift in focus on unit economics, companies that have a path to profitability or are profitable, because those are the companies that have the most likely exit into the IPO market or joining a strategic, for example.
How is technological innovation going in a world where rates are higher, right? Policy in the U.S. is questionable of where it's going to be in November, where I'm thinking of energy, right? Like a lot of the cool new stuff are coming out of these startups that you need in order to sort of do the energy transition, but that's not as popular with certain folks in D.C. Where is the cool stuff happening?
I would say a lot of it still is in software.
Okay.
The biggest area probably that's had the most investment dollars recently and more that's on the public side is on the chips because it's sort of an easy way for investors to get behind the boom in AI without picking which software winners are going, which software companies are going to be the winners. The other area within tech that we're seeing a lot of investment is on payments, fintech type businesses. That continues to be very popular.
Where is the IPO market these days for technology companies?
Yeah, so
I'd like to see more, quite frankly.
I would
so
too.
if I were back on my capital markets days, I could get a lot more deals done. I don't know what you guys are doing.
Yeah.
So what's happening out there?
Well, a couple of things happened over the last couple of years. There have been two things. One, a meaningful valuation reset, where we had companies coming public at 2x, 3x the historical norms for on a multiple basis.
Yep.
That reset's happened. The other thing is there's been a much more meaningful focus on profitability, and so a lot of the private companies that were poised to hit the public market, say in 2023, 2024, have now had to come back and figure out how to accelerate their path to profitability, also get to bigger scale. I mean, one of the issues that we've seen from the class of 2020 and 2021 IPOs, the ones that have massively underperformed have been the smaller scale, less liquid names. And so there's a focus on scale, profitability, and growth, and finding that balance. And then we're also at this very moment in a bit of a pocket of uncertainty leading into the election, leading into seeing where and when rates start coming down. So for that reason, we've seen a handful of tech IPOs, but not a significant number.
We clearly see a ton of public money going into like NVIDIA and peers and derivative plays, right? Is it the same kind in private capital? Like you were mentioning, it's still in software and the chips, right? Like that's where the money's flowing. Is it the same kind of ferocity when it comes to money flowing in?
Less in companies that haven't reached a significant scale. And part of that is because the obvious exit is an IPO or a sale. And we haven't seen a lot of strategic buying yet of the earlier stage AI type businesses. Some acqui-hires, like just buying, entrepreneurs, engineers, but not necessarily the kind of larger M&A. And so once you start feeling once investors can feel confident in the private world that they have a path to exit, whether it be IPO or sale, then you get more courage to invest in the growth stage companies.
How frustrated are your private equity and your venture capital clients in the fact that the IPO market is not robust and maybe exits are not as fundamental, so they're holding on to these things much longer than they would typically like? What are those conversations like?
Yeah, look, there's a huge pent-up number of companies that have stayed within venture or private equity for much longer than they'd anticipated. I think that there's a difference, though. The venture-backed businesses, some of them haven't been able to figure out the path to profitability and actually get to a place where they could easily go public. So it's more about finding a strategic home. On the private equity side, a lot of these companies that were LBOs or have gone typically sponsor to sponsor sales have now gotten so big inside private equity that really there are two options. It's either sell to a very large strategic or take the companies public. And most of them have financial profiles that would actually look good in the public market because they're profitable and have, maybe modest growth.
So if we get once we get clarity on the U.S. election and we get clarity on Fed rate cuts, what does that IPO market look like? Is it like a flood? Like how do you think about that?
I think that there are, I think we'll have a lot more companies that are willing to move forward with an IPO once we have that behind us, because there aren't a lot of other alternatives at that point. It's like either you sell to a strategic or you take the company public, and they've gotten to a scale where actually the visibility of being a public company is helpful sometimes with their customers. It's helpful with employees. It helps provide liquidity for companies that have been private for 8-10 years.
It'll be like a flood. Yeah. IPO flood.
I hope so.
Okay.
Are we going to have an AI IPO aha moment like Google was for search, Facebook was for social? Are there AI specific companies that are going to come out and boom, that's going to be the IPO event of the year?
Well, the ones that have so far have been chips related, right? In the last 2 years, I would say that there will be at some point, but it's just too early to tell who those winners are going to be.
You talk, people in your world talk about digital infrastructure. Like, what is that? What is a digital infrastructure, and how does that change and progress?
Yeah, so there's a massive transformation happening within a number of industries that's being enabled by tech, and that's the transition from things like on-premise to cloud-based technologies, and just changing the way that we've done things that, from historically to moving things to more tech-enabled. That's true in like healthcare sector, insurance, financial sectors, banks, for example.
So for you guys at Barclays and your franchise these days, where's the most activity here? What are you guys really focusing on here?
I think back to the question around private equity pressure, I think there's a lot of sponsor-backed assets that are either, private equity firms are under pressure to return capital to LPs, and so there will be more sales. I think there will be minority stake sales as well to get some liquidity back, but also to provide a mark. And then I think after that comes the kind of more larger scaled businesses that have profitability and some growth.
Paul's really into the investment banking part, and I'm into the tech part. Like, he wants to be like, okay, when did things open? What are sponsors talking about? And I'm like, what's the disruptive, cool technology? How does digital infrastructure wind up changing? Like, what's the cool thing that we totally don't know about?
Oh, gosh.
Like me and Paul.
Yeah.
A lot would be said. Yeah.
Well, right now, I think the focus for most companies is how do we use AI to generate efficiencies? That's the first part, right? And that's an easy sale.
That's like, how do I go through my email more efficiently? That kind of thing?
Yeah,
okay.
or how do you cut costs with call centers or fraud protection or things like this that you're maybe doing in a way that it requires more people or kludging together different technologies. Here's a way there are solutions now that can make that easier, and that's going to create profitability, more profitability. And so that's the first step. I think the next question is which AI solutions are going to enhance innovation. And that's really where it starts to get interesting. And that's probably where you see the biggest threat to the large cap tech companies is the new incumbents or the new entrants that have some sort of they can scale much quicker because of the technology that they have around innovation.
Fintech, where are we in that evolution? I think during the pandemic, everybody, myself, I do a lot more of my financial services just on the phone.
Yeah. Which was a big moment for Paul. Let's just be very clear on that point. He still carries cash, but still.
Exactly. Where are we on that kind of that pendulum? Where do you see that?
Look, I think there was a period where I remember spending time in Asia, and I was in Hangzhou where you could not use a credit card. It went straight to mobile, right? It went from cash to mobile. Here we've gone, we had credit cards. We're now very much in the mobile world. The next thing I think is going to be biometrics. And that's a trend that's already happening in Asia that I think will make its way the rest of the world over time.
Wait, dumb question. What does that mean?
So being able to pay with your eyeballs for example, or some sort of, fingerprint.
So when Europeans come over here, they're like so amazed that when you're in a restaurant, you hand your card to the waiter,
the
waiter
God,
walks
don't
away.
Understand. Yeah.
Like, whoa, come back here. Because, the rest of the world, the waiter carries around a little thingamajig.
Or even like the tapping thing.
We were 2 or 3 years behind the tapping thing.
Even that, I don't think my credit card does the tapping thing. Like, I have to do my phone to do the tapping thing, but the credit card doesn't do the tapping thing.
Your credit card taps.
It does? Are you sure?
Okay.
Well,
we got the expert here. Kristin can help us out.
Does my credit card tap? These are the questions. These are the pressing questions.
We have.
She's like, I don't know. All right, Kristin, thanks a lot. We appreciate it. Thanks for stopping by. Yeah. DeClark. She is a global head of technology investment banking over at Barclays, talking about all the innovations that are upcoming. And then what do you do if you're a company and you have cash flow and you can't IPO and sort of treading water until you can and the markets really open up?
And the companies are so much better now than people make that. Are we close to the 1999? And having been in that marketplace, the answer is definitely no, because these companies are bigger, profitable, they have free cash flow. The companies I were taking public, it was a thought out there in the world.
It was like pet.
And we put a 30, put a 30 multiple on it, and we were done. That's all we needed. It's much harder for these people. They actually have to have real businesses and real companies.
It's a good thing.
It's a good thing.
Yeah.
It's a good thing.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.